It's Brian Preston, the Money Guy.
The first one is from YouTube from Niranhan. I'm sorry if I'm saying that wrong. I'm pretty sure that's what it is, though. The question is, the market crashed in 2000 and 2007, took almost 6 years to get back to pre-crash levels. So the question is, why should I keep investing now if the market could be flat for 5+ years? Shouldn't I just wait?
Oh, that's a good one. That's a really good one.
By the way, for point of clarification, market was not just flat. That's why I wanted to make sure I focused on the shape of typical recoveries with that V-shaped pattern, because I think when you see people say, because you also, I'll just expand it out to, you hear about the lost decade. Mm-hmm. That period of the 2000 and 2010 is what everybody brings up as the lost decade, because it took that 10 years for the S&P 500 to actually break positive over that period. But it's not like it was fighting for recovery through that, because realize you hopefully, and this is why we give you so many strategies, we're counting on you to have things to help you take advantage of the volatility. One of the biggest things you can be doing is dollar cost averaging, meaning that no matter what's going on in the economic world, you are buying through it. I mean, you're buying every month, every quarter, at least annually, maybe when you're funding your Roth IRA. You need to figure out, how do you stay consistent so your wealth building is automatic? Because guess what happens in this thing that the news media is pushing as the lost decade? If you were buying during every one of those years that the market's getting beaten up, and the years that it was getting beaten up in there was 2000, 2001, 2002, and it was the depth of how bad things got, especially in 2002, because we hit the bottom in around November of 2002. It's the depth of how bad it was that drove those returns down, because when markets lose, greater than 25%, it really takes a while to get that back to positive. But it's not one of those things where if you were buying through the process, that's some of the cheapest shares, because that's the ideal or maximum point of financial opportunity for you personally. So I would tell you, don't let somebody scare you saying, hey, sit on the sidelines, because I worry about the person who says, hey, I feel good because I read in a news clip, it took 6 years to get back to positive. So I'm going to wait. I'm going to pull my money out right now and wait until I feel like the coast is clear and it's time, because we've done lots of strategies, lots of content on the best market timer in history. And I can tell you, consistency always wins.
Yeah, we've done some mathematics on this before. And if you've seen this before, we said that if you lose 10%, you don't just have to make 10% to get back to break even. You got to make 11%. If you lose 20%, you don't just have to make 20% back. 40, you don't have to just make 40% back. One of the real interesting things when I think about practically how this works out is, you said that it took 6 years for the market to get back to break even. Well, most people who are investing, most people who are building their army of dollar bills, subscribe to this idea of diversification. I'm not just going to have everything in one basket. I'm going to spread out my assets so that when the market's going down, I may not be doing exactly what the market is doing.
That's exactly
I may
right.
be losing less than the market. So if the market's down 40%, but I have a well-diversified portfolio that takes into account my unique risk tolerance, risk capacity, time horizon, I may only be down 20%. Well, if that's the case, when the recovery happens, when the markets turn, when they start coming back, it should not take my portfolio 6 years to get back to break even. And anecdotally, we've seen this with clients, right? A lot of clients, or a lot of individuals, or a lot of listeners, a lot of friends, a lot of colleagues that we work with, 2008 and 2009 were bad and they were tough, but it was not uncommon for portfolios to be back to break even in 2.5 to 3 years. It wasn't this full 6-year cycle that it took for that to take place. So a well-diversified portfolio can help protect against that, along with the tools that you mentioned, dollar cost averaging, getting money working for you, taking advantage of the market going down. So I don't think I would subscribe to just wait. I would take a drink. Again, if you want to go back to that recession show that we did, we walked through what DRINK stands for. And those are some things that can help you stay protected as we do move through a downturn.
Yeah, I mean, if you're at least 15 years from retirement, you ought to, in some weird counterintuitive or Warren Buffett way,
It's gonna be a financial mutant way.
You ought to get excited about the volatility, because these are going to be some of the best performing years that you could put that money to work. And that's why we haven't reached it. I keep waiting for us to cross the 20% mark so I can do my walk through the halls and be like, guys, bottle it up. This is the most valuable learning experience you're going to have in your financial career, is going through a downturn and learning how to navigate the conflict that you have emotionally with the understanding of how this all works from a psycho and analytical side of things so you can maximize this opportunity throughout the rest of your career.